Hey everyone! Nebius Group N.V, trading on NASDAQ under the ticker Nbis, has recently come under pressure, sliding by more than 3.5% in a single move. For many traders, a drop like this immediately raises questions. Is this just another temporary pullback, or is something deeper unfolding beneath the surface? Today, we're breaking down what's really happening, why the stock is moving the way it is, and what traders should be thinking about in moments like these. In fast-moving markets, emotions can quickly take control. Price swings trigger excitement, anxiety, and sometimes impulsive decisions. It's easy to feel like every move is a once-in-a-lifetime opportunity, but seasoned traders understand a crucial truth. The market will always provide another setup. Acting out of fear of missing out often leads to poor timing and unnecessary losses. Discipline, patience, and a clear strategy matter far more than reacting to every sudden fluctuation. When we step back and look at Nebius Group's broader financial picture, the story becomes more complex. On the surface, the company reports over $100 million in revenue, which sounds impressive at first glance. However, digging deeper reveals some concerning trends. Recent quarters show declining revenue, and when stretched across a longer 3 to 5 year horizon, the pattern suggests contraction rather than growth. In an industry defined by innovation and aggressive competition, sustained revenue shrinkage is not something investors can easily ignore. Profitability metrics also tell a cautious tale. Nebius operates with a pre-tax margin hovering just above 5%, a figure that leaves little room for error. Thin margins mean that even small disruptions, rising costs, or shifts in demand can quickly impact earnings. While the company's leverage appears relatively moderate, financial ratios tied to asset efficiency hint that capital may not be working as effectively as it should. Returns on both assets and invested capital remain under pressure, adding to questions about long-term operational strength. Valuation is another critical piece of the puzzle. Nebius maintains a high book value per share and a solid tangible book foundation, which can initially signal underlying stability. However, when you compare that to an extremely elevated price-to-book ratio, it raises eyebrows. Such stretched valuations require strong fundamentals and consistent growth to justify them. Without clear momentum on the revenue or profit front, the risk of valuation compression becomes very real. Market sentiment around the stock reflects this uncertainty. Traders have watched price action struggle to find consistent footing, particularly during recent months. Volatility has become a defining feature, with sharp intraday moves in both directions. These swings often reflect nervous positioning, where participants react quickly to headlines, macro developments, and broader shifts in the tech sector rather than long-term conviction. The broader environment matters as well. Technology stocks as a whole have been navigating choppy waters, influenced by global economic signals, interest rate expectations, and ongoing industry-wide adjustments. In markets like this, even companies with solid foundations can experience exaggerated price movements. External news cycles, speculation, and shifting investor risk appetite can easily amplify downside pressure. For traders, this creates a delicate balancing act. On one hand, Nebius still holds assets, infrastructure, and a presence that could support future recovery if execution improves. On the other hand, persistent volatility and unresolved financial questions demand caution. This is where experienced market participants lean into risk management rather than prediction. Protecting capital often matters more than chasing uncertain upside. A well-known principle among professional traders is knowing when not to trade. Sometimes the smartest move is patience, waiting for clearer signals, stronger confirmation, or improved fundamentals before committing capital. As legendary trader Tim Sykes has said, "It's far better to walk away without gains than to stay too long and suffer avoidable losses." That mindset becomes especially relevant in environments where direction remains unclear. Right now, Nebius Group sits at a crossroads. Some traders are watching closely, waiting to see if stability returns or if further downside reveals deeper structural issues. Others remain on the sidelines entirely, preferring to observe how upcoming financial updates and broader market conditions unfold. Both approaches are valid, depending on strategy, time frame, and risk tolerance. What's important is maintaining perspective. Stocks don't move in straight lines, and short-term declines don't always define long-term outcomes. At the same time, ignoring warning signs can be costly. The key is staying informed, objective, and disciplined while adapting to changing conditions. Finally, it's important to be clear about the purpose of this discussion. This is stock market news, not investment advice. The goal is to explain recent price movements, highlight potential catalysts, and provide context for active traders and investors. Many use this type of analysis to understand sudden volatility, while others incorporate it into broader research efforts. In fast-moving and speculative areas of the market, knowledge and preparation remain the most valuable tools. As always, trade responsibly, manage risk, and remember that the market rewards patience far more often than impulse. Subscribe to my channel. This is not financial advice.